stunning inflation number, making everyday goods like gasoline or groceries more expensive. Prices are up 7.5% compared to 1 year ago, rising at the fastest rate in 4 decades. We bring in Gregory Daco. He is the chief economist at Ernst and Young Parthenon for more. Greg, thank you so much in advance for the time. Where are you seeing Americans feeling these effects the most?
Well, I think what we're seeing in terms of inflation dynamics is that it's hurting a lot of consumers where it hurts the most. That is in terms of food prices, in terms of energy prices, and now increasingly in terms of housing costs, rental costs. So it's a broad-based increase in inflation that is weighing on consumers' ability and desire to spend in this higher inflation environment. As you said, we are experiencing the hottest inflation we've seen in 40 years. We do expect inflation to cool over the course of 2022, but that cooling will be fairly gradual.
Fairly gradual. So as you mentioned, I mean, food, gasoline, rent, it's everywhere across the board. So the Federal Reserve has signaled that it plans to raise interest rates. So does the data point that we get today change the pace? Does it change how the Fed is going to respond?
Well, I think it does. We have already started to see some policymakers hint towards faster increase in interest rates. We've seen some policymakers suggest that a 50 basis point rate liftoff from the zero lower bound where we currently are is adequate. I would be careful because what we're seeing right now is that financial conditions are tightening, and we are seeing this tightening in financial conditions with interest rates rising ahead of the Fed as something that could actually hurt the economy. If the Fed slams the brake too rapidly, we could be in for an environment where we have the worst of both worlds, essentially higher inflation and higher interest rates. So we have to be very careful, and the Fed has to be very careful to calibrate policy in a way that does not seem like it's slamming the brakes and does not lead to a more recessionary type of environment.
Greg, what signs are you going to be watching to be reassured, if I can use that word, that the Fed is straddling these two worlds, those two strategies appropriately?
Well, I think we will have to see the type of communication that we get from Fed Chair Powell and some of the Fed governors over the next few weeks. We have the all-important March meeting in about 4 weeks' time. That is when the Fed is expected to proceed with rate liftoff. Just a couple of weeks ago, expectations were that the Fed would essentially raise rates by only 25 basis points, so not that big of an increase. But there is increased speculation that the Fed may want to go faster than that, and that's what markets are pricing in right now. And that's where I see a potential risk, because if financial conditions tighten, you get a negative effect on stock markets. It can affect business decisions to hire, to invest, and it can also affect consumers' ability to spend and buy in an environment where you have less growth. So I would be very careful as to how financial conditions evolve over the next 4 weeks.
We do hope the Fed moves gingerly. Greg Daco, thank you very much. Appreciate it.
Thank you.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.